Hi, everyone. Thank you for joining us today here on this lovely day, the 21st of April, 2025. No time like the present to kick us off. My name is Liam Purcell. I'm a senior counsel here at Arthur and one half of the co-hosting duo today, alongside my friend and colleague Hend Rashwan. And today, I guess the topic of conversation is going to be Pillar 2. In particular, we'll be looking at the recent developments that have occurred in the GCC. So today's session, I'll just give a quick rundown of the agenda before we kick off. So it's going to be a relatively quick fire session, just giving, as we said, an update on the Pillar 2 developments in the GCC. So at the outset, we thought it might be relevant to have just an overview, a recap of the rules. The first Globe rules were released in December 2021, 3.5 years ago now, nearly at this stage. Time flies when you're having fun in tax. So we'll just give a very quick update or refresh, I guess, on some of the core principles that may be applicable. Following that, my colleague Ken will go through the implementation status of the Pillar 2 or Globe rules amongst the GCC nations. That will include things like compliance obligations. We've actually seen one already come and go in Bahrain. As well as looking at maybe the qualified status of certain elements of the charging provisions that will indeed have an impact both locally as well at a group level in terms of how the calculations shall apply. As well, we know from Pillar 2 now already that there's a lot of data requirements. It's going to be a lot of additional potentially complex calculations for multinationals. So we'll be discussing some of the safe harbors that have been made available through the legislation released to date by the GCC countries. We'll also touch upon the rumblings from the West, the US, and the potential implications there on some of the rules in question. And indeed, we'll look to finish with a Q&A session as well to answer any questions that you may have. So I guess to kick us off with the general overview, what is the Pillar 2 rules of the Globe rules? So we know that these are rules that have been designed in order to ensure that multinationals are paying their fair share of top-up tax across all jurisdictions in which they operate, looking to get to a minimum level of taxation. The agreed minimum effective tax rate is, of course, 15%. The OECD, as mentioned before, they've released a number of model legislations going back December 2021 and even before then with the blueprint. And since then, there's been a proliferation of documentation and further guidance, keeping all of us tax professionals very busy, a lot of bedside reading. So again, this is somewhat novel approach, revolutionary, if you wanted to be very verbose with the wordage. It's the first time there's been a very coordinated effort amongst all the inclusive framework members. And just up on screen, we see there's over 145 members signed up to this. Not everyone has introduced legislation as of yet. Critically, all GCC countries are members of the inclusive framework, but as we'll see, there's maybe different degrees in terms of the level of adoption to date. As well as many traditional tax havens, and also we see that there are some in the wider Middle East that haven't yet signed up, but not really too relevant for today's discussions. So just going into some of the charging provisions in the first instance. So we have here, I guess, the two core components of the Globe rules as devised by the OECD would be number 2 and 3 below, but we'll start off with the domestic minimum top-up tax, or QDMTT. So that is effectively allowing the source jurisdiction the opportunity to first tax any profits of a constituent entity located in that jurisdiction where their effective tax rate is below that minimum rate. So it aligns kind of sourcing rights first, having first go at the profits, as it were. And we'll see, not to be a spoiler, but a lot of the jurisdictions that we're speaking of in question have introduced a domestic minimum top-up tax. The difference between domestic minimum top-up tax and qualified domestic minimum top-up tax we'll also discuss in a little bit further detail later when we talk about the qualified status. The income inclusion rule then, that is the top-down approach, and it's kind of the main provision to ensure that the top-up tax is affected. It's generally done through a parent-sub arrangement. It will be the ultimate parent entity will have the first port of call in order to tax any low tax jurisdictions where the effective tax rate doesn't hit 15%. Worth noting there as well that there are indeed some complications or allowances for any split ownership, as well as some offset mechanisms in place to avoid any double taxation where there are multiple parent entities in the structure. And then last but not least, we've got the bad boy of the group. That is the undertaxed payment rule, the UTPR. This is the one that's causing a little bit of a ruckus, so shall we say, by the US. And effectively, this acts as a backstop. So in the event that there is a low tax jurisdiction, effective tax rate below 15%, that jurisdiction does not impose a domestic minimum top-up tax, and indeed the parent entities above do not impose an IIR, then it would grant taxing right on any other subsidiary within the group to ensure that that jurisdiction is taxed at 15%. That can be done by way of either the denial of a deduction or indeed a top-up tax similar to how we see in the IIR. So very quick outline of the rules. I will say that the UTPR has been purposely left out, given some of the uncertainties around it. But in this example, we've got a French headco, as well as two UAE operating companies, one with an effective tax rate of 9% operating in the mainland, and then the other in a free zone where its effective tax rate would be 0% through the preferential regime. And as we said, the DMTT, spoiler alert, has been introduced in the UAE. So the UAE would indeed have the first port of call for periods beginning on or after January 2025. But say for the 2024 year, we know that France has introduced, as part of the EU directive, the IIR. So for 2024, for example, any difference in the effective tax rate would be captured at the headco level through the IIR. So taking a step back then, like who is within scope of these rules, we talked about large multinationals. So specifically, the revenue threshold is 750 million euro, looking at the consolidated revenue of the group, must be in at least 2 of the preceding 4 financial years. I guess the key point to take away here is that it relies on consolidated revenue, so it does tie back a lot to accounting principles. You're looking at kind of the UPE as a whole. And in terms of consolidation, it's also worth noting that indeed joint ventures are specifically included. So even those under the equity-based method of accounting, they would be subject to the rules, albeit maybe a slightly different way in which they calculate the effective tax rate. And when we just look here at a very high level, again, this is going to be a short and snappy webinar, so we won't go into all the intricate details, but at a high level, the ETR is calculated on a jurisdictional basis, and it's done by taking your covered taxes, which includes things like, corporate tax expense, but as well other things maybe generally in lieu of corporate tax or on an equity base. For example, zakat is specifically called out in the OECD commentary as being considered a covered tax. So that would be the top half of your equation, and then the bottom half is your globe income. Broadly, that is your financial accounting net income as a starting point, as well with some adjustments that do take place as well. So then when we look at how do you actually calculate the top-up tax, the top-up tax percentage is taken by, once you've calculated your effective tax rate as shown on the previous slide, you would then subtract the minimum rate 15% by the effective tax rate to get whatever top-up tax percentage. I think crucially here for the jurisdictional top-up tax, we would look at applying the top-up tax percentage by the excess profit. So rather than on your globe income or something like that, it's on your excess profit. And that's where we look into the substance-based income exclusion, which we'll talk about briefly on the next couple of slides. And then there's the additional current top-up tax, which we won't go into too much detail about today. And indeed, if it was an IIR, you would also potentially look to exclude the domestic minimum top-up tax applied. Excess profit, as mentioned, that would be your net globe income less your substance-based income exclusion. The substance-based income exclusion is an allowable deduction to reduce the total amount subject to the top-up tax percentage. It's broadly based on allowable payroll costs and tangible assets. We have a few examples up on screen. You would exclude a fixed return for substantive activities. The idea is that it would reward taxpayers that have sufficient economic presence in the low tax jurisdiction. And we can see on the next slide as well that it's on kind of a sliding scale. So over time, it's decreased from percentages of 10% and 8% right the way down to a final steady state of 5%. I guess the key thing for most GCC countries is going to be that 2025 amount, 9.6 and 7.6%, as most will have implemented by that date. And then the final bit for me before I hand over to my colleague Hend is just a very quick example of maybe some of the benefits of the substance-based income exclusion. Again, we're including it by reference to the UAE and the free zone regime there. We do have a number of clients that are Pillar 2 operating in a free zone, and they have asked, well, what's the benefit for me of, looking to go through all the hoops to get to that 0% if it's going to be effectively counteracted by the top-up tax. And really here it's a short numerical example, but it shows effectively that if you do have a substantial amount of substance-based income exclusion, the fact that the top-up tax percentage is applied on your excess profit rather than on your globe income, that it can really have quite a substantial effect on indeed the ultimate effective tax rate that is paid at the UAE level. So yeah, thank you very much for that. I'll be on a little bit later, but handing over to Hend now.
We'll start with the implementation in the GCC and the current status as of date. So as most of you would already be aware, the UAE, Bahrain, Kuwait, Qatar, and Oman have all announced their implementation for the DMTT. Most of these jurisdictions have also issued legal instruments, as you can see on the right-hand side of the slide. And if we go further, Qatar and Oman have exclusively also announced that they will also be implementing the IIR effective Jan 1st, 2025. None of the GCC states have announced anything in relation to the UTPR, and we are not expecting as of right now that anything in this regard would be announced. And in regards to KSA, I think this is everyone's biggest question, what the status is. Will they be announcing anything anytime soon? But considering the fact that their CIT is at a statutory rate of 20%, it makes sense why they have not announced anything yet. But then the question over here is what happens with anyone that is within the scope of the zakat tax, because we are talking about a 2.5%. So there will definitely be space for tax leakage over there. So we're expecting that there should be information in this regard sometime soon. And over here, we'll be discussing a bit more or going into what the status is in relation to compliance. So that over here, we look at the registration, the return filing, and anything in relation to payment. So Bahrain has been the first country to have a deadline that has already lapsed. The registration deadline in Bahrain is 30 days from when the law goes into effect. So for a lot of entities or constituent entities or groups that are within the scope, this timeline has already lapsed. So we're waiting to hear whether there is going to be an extension. Has everyone registered? It's not really very clear what the status is as of right now. Kuwait has also specified that the registration deadline is 120 days from falling within the scope of the law. So there is still a time period, and this registration period is only for the first year. In regards to UAE, Qatar, and Oman, we're still waiting for further detail. As of right now, there isn't much information in relation to when constituent entities and anyone subject to the law is supposed to register. So we're expecting further detail in that regard. In relation to the return filing, what we've noticed is almost all jurisdictions in the GCC are following what the OECD has recommended, which is an extended period for the first year, which is 18 months, and thereafter, your regular 15 months after the completion of the fiscal year. The only one that has taken a bit of a different approach, again, is Kuwait, where they have not abided by the extended period of 18 months. Instead, they went for the 15-month period after the end of the financial year. And this is the exact same method that will continue thereafter. The only other detail over here that I would like to add is in relation to payments, where we are now aware that Bahrain has implemented the concept of advance payments when it comes to your DMTT liability and payment, where advance payments will be due on a quarterly basis. However, for the first quarter where you're subject to the rules, your advance payment will only be due with the second advance payment. So you basically have 2 quarters to make the payment for the first advance payment, and the deadline is another 60 days after the completion of your quarter. Just to tie back on the qualified status and what Liam was referencing to earlier, where he was saying that we would discuss what the difference between a DMTT and a QDMTT is. This is the main slide where we discuss this topic. The whole idea over here is what makes your domestic minimum tax qualifying. Is everyone going to be getting the status? Is it something that's attainable? Is it something that the OECD is making it complex? We are still trying to understand how it works. The basic idea here is the Pillar 2 rules are standard rules that all jurisdictions are supposed to follow. And this is exactly what the qualified status does. It basically gives you a stamp that as a jurisdiction, yes, you're aligned. The rules are consistent. There isn't any major inconsistencies between the rules that you're applying in the jurisdiction and the rules as per the OECD. So what happens here is that jurisdictions are supposed to undergo this process known as a self-certification, wherein the legislation is reviewed, whether it's final or in draft form. And based on that, in the initial period, you get a transitional qualified status, because as you can imagine, it would be a bit difficult to go through the whole legislation to be able to determine whether it qualifies or not. The full review would only happen 2 years post the effective date that the legislation came in. Apart from that, the qualifying process happens in the sense that it's a peer review, where there's a self-certification form where the jurisdiction fills in the form and the IF members review this. They give their comments. If all good, no comments, you have abided by the rules, you're more or less consistent, you do get the stamp, and it basically helps your domestic minimum tax to be considered as qualifying, which is something every jurisdiction is looking to achieve. We'll go a bit more into some of the reliefs, let's say, that are provided by the OECD in relation to the Pillar 2. As we all know, this is something that's going to be a bit more complex. It's going to involve a lot of time and an additional burden overall to any M&E group that falls within the scope. And for the transitional period, the OECD provided this kind of a relief, wherein for specific financial years, the top-up tax would be considered as zero, provided that the M&E group meets one of the following tests that we will discuss. The key point over here, or what we need to mostly note, is that this is all prepared based on a qualifying CBCR report. So this is something that's extremely important. It's important that the CBCR is up to a particular standard in order to be able to take advantage of this relief. And another thing is that it is applied on an election basis. It's not something that automatically applies to a group. It's something that you need to specifically elect for. And there's an interesting nuance here where the OECD has mentioned that if you do not elect or you do not apply these transitional rules within the first year that the group falls within the scope, they will not be able to use this relief later on. Of course, there are certain exceptions that apply, but this is the general rule. So now we'll go into what these tests are. They're pretty basic. There are 3 main tests, and the M&E group is just supposed to meet any one of the following in order to avail this benefit and basically have a top-up tax of 0 for the particular financial year. So the first one is the de minimis test, wherein both of the conditions mentioned on the slide need to be met. It's not an either-or situation. It's both your profit before tax does not exceed 1 million euros and the total revenue of all the entities in the jurisdiction should not exceed 10 million euros for the particular year. The second test, which is the simplified ETR, and the idea over here is that your simplified ETR, which is calculated as per the formula mentioned on the slide, should not be above the transitional rate. It needs to fall below the transitional rate. Applicable transitional rate will depend based on the year that you're conducting the calculation in. So 15% for the year 23 and 24, 16 for the year 25, and 17 for the year 2026. And the final test we have is the routine profits test, wherein your SBIE that Liam had previously touched upon the concept of that. It needs to be equal or greater than your profit before tax. Last but not least on this topic is there's this concept of a permanent safe harbor. As we mentioned, the transitional CBCR safe harbor is only for a transitional period. So it's only for the first few years that the rules come into effect. However, the OECD has continued this type of a relief by the introduction of the permanent safe harbors, wherein it basically says that, okay, you might be an M&A group that does not or is unable to benefit from the transitional safe harbors for plenty of reasons. On the other hand, you may be still eligible to use the permanent safe harbors. The whole idea is the same exact tests apply, but the only difference over here is instead of basing it on your qualified CBCR report, you base it on a different method of calculations, which is referred to as simplified calculations. As of right now, we're not entirely sure how this will happen or what constitutes as a simple calculation. We just know that it reduces the general complexity of calculating your top-up tax. We're awaiting further details from the OECD on this manner of calculations. I will now pass the mic to Liam.
Hey everyone, stepping back into the hot seat. I feel like a news presenter. So yeah, we're going to be talking just very quickly because we want to leave some time at the end for Q&A, but just talking about US policy reactions. So as we mentioned before, the UTPR is kind of the bad boy of the group. It's the one that's probably been having the most kind of reaction from the Trump administration since they've come in. I won't even begin to try and explain what those guys are doing in terms of their wider tax reforms and policies in terms of the tariffs and everything else. But we did note that, you know, upon coming into office, the Trump administration did issue a memorandum specifically in relation to Pillar 2 and specifically in relation to the UTPR and expressing their discontent. I think previous to the new administration coming in, there had already been some representations from Republicans in Congress around this point. So it was kind of expected to come in. But I guess now that they are indeed in for the next 4 years, it's raised some concerns amongst tax professionals or businesses more generally in terms of what this means for the Pillar 2 rules. Again, we'll keep this short and sweet. I think the core takeaways here is that Pillar 2 is here to stay. It has already been implemented in the majority of EU countries, applicable from 2024. We now see, as Hend has discussed, that at least the domestic minimum top-up tax and the IIR, in the case of Qatar and Oman, have been introduced in the GCC, or the large majority, subject to the KSA. So I would say it's here to stay, at least the domestic minimum top-up tax and the IIR, and the UTPR in any event was always, as we mentioned, a backstop. I think in practice it would apply. It would be very unlikely to apply. So again, I don't know why they've raised so much concerns about it, but again, you know, very difficult to tell what's going on there. So yeah, key takeaway is I think Pillar 2 is here to stay, and the US just need to sort themselves out, really. So yeah, I think we can enter the Q&A session now. In terms of how that'll operate, I think we will open up the chat and just to the extent that there are any messages, please feel free to put them into the group and we can go from there. Q&A. Okay. So we've got a couple in so far. Anonymous attendee. Is it confirmed that QDMTT in UAE will prevail over the foreign constituent entity? Short answer is yes. So indeed, any free zone person that's subject to the preferential rate of 0%, they will indeed be subject to like 0% at the corporate income tax level. But the way that it works, the mechanism, of course, you would then, from a globe perspective, need to calculate your effective tax rate, which in this instance would likely be 0 unless there's some other income that may be subject to tax at 9%. And indeed, there would be a top-up tax payable. As we mentioned, it would be on a reduced base potentially with the substance-based income exclusion. But in short, indeed, it is confirmed that the QDMTT will prevail over the free zone. So then looking at the next one, can you give us the time frame for UAE companies, assuming December is the year end? So in terms of time frames, I believe like compliance obligations haven't fully been ironed out at this stage. I believe there is still some further details to be released, particularly in relation to the actual filing of the domestic minimum top-up tax form. We know that the GIR itself, the Globe Information Return, will be due for filing, I believe it's 18 months after the applicable financial year in the first year, and that will fall back to 15 months. The domestic minimum top-up tax then will probably fall somewhere in between. The filing of your corporate tax return, 9 months, and the 15 months. I think that's the expectation. But again, it's a little bit of watch this space. Another anonymous attendee, great session. Well, thank you very much. Is there still a benefit in incorporating in a free zone? I'll let my colleague Hend answer that one maybe. I don't want to hog all the limelight.
That's fine, Liam, you can do that. But I think this ties back to the answer that Liam had just given. The whole idea over here is everyone will need to calculate their effective tax rate. And if your effective tax rate is 0, anything over and above that will still be due as a top-up tax. So to answer your question, if you're part of an M&A group, not likely very beneficial to incorporate in the free zone because the benefit will not really be available considering the application of the rules.
Yeah, that's broadly correct indeed. So then the de minimis threshold applies for each constituent entity. I do not believe that is the case, actually, unfortunately. So you would look at it on a jurisdictional basis, so as a whole. So to the extent that you have multiple entities, indeed, if one of them falls beneath the threshold, but then others bring it above, then unfortunately, the de minimis would not apply. Another one from Nasir. What is the effective date of the legislation for the UAE?
1st January 2025.
Indeed. So for accounting periods beginning on or after January 1st, 2025. So unincorporated joint ventures, owners are 2 different foreign branches, be subject to Pillar 2 regulations. I believe the short answer would likely be yes, but again, it might depend on the ultimate, global revenues or that joint venture would be earning, or indeed, so owners are 2 different foreign branches. Foreign branches, I guess you would have to go further up the structure or the scale to understand, indeed, would the 750 million euro threshold be met? So. That's probably one that would require a little bit more analysis on the face of things. It's difficult to say completely, but joint ventures indeed do have some hidden quirks to them that would need to be considered in a little bit further detail. And then we might just finish up with one more because conscious we're a little bit over time. So will the M&E companies be liable to file 2 returns, one for normal CIT within 9 months and then 2 within 18 or 15 months? I'll leave that to Hend.
Well, fortunately or unfortunately, there are 2 different laws or tax laws. So CIT would have its own compliance obligations, which is, as you mentioned correctly, within 9 months. And on the other hand, you would also, provided that you fall within the scope, of course, will be also liable to meet the compliance obligations from a DMTT perspective. Compliance, completely separate tax laws, completely separate compliance obligations. So the answer is yes.
Yeah. And then I told a lie. We'll answer one more because I think it's an interesting one here. So in case we're expecting to acquire a US-based group, should we await further until the clear tax policy from Trump administration release? My general viewpoint on things is that although it is obviously important for tax to be involved in any kind of business decisions, ultimately, tax should follow the business decisions. Like if this is a viable commercial option, I think depending on what kind of business you're into, if it's products and stuff like that, there's also tariff considerations, etc. So there's a lot of uncertainty with the US more generally at the moment. So I wouldn't let that stop proceeding with a viable business opportunity, I guess, would be the short and sweet of the answer. So listen, I guess we didn't want to take up too much of your time today. I hope it was informative. I know there are some further questions in the group. in the Q&A chat, but do indeed feel free to contact either myself, Hend, or indeed anyone of your contacts here at ORFR. We would like to thank you all very much for attending. I'd also like to thank Hend for joining me on this fun little sojourn down the Pillar 2 Riviera, if you will. So now concludes the end of our webinar. As I said, please do feel free to reach out if there's any further questions. So final thing, very happy Easter to anyone who's celebrating. So yeah, all the best and we'll speak soon.
Thank you.